This is Gavin Serkin for Frontera TV. Joining me from JP Morgan is Zsolt Papp. He is the Global Head of Emerging Market Debt Client Portfolio Strategies. Thank you very much for joining us, Zsolt.
Thank you.
So can you start by really explaining your role, what it is you do for your clients?
Yes, Gavin, I'm a client portfolio manager. And some places it's also called product specialist. But it is de facto being the interface between the investment team and I'm tempted to say the rest of the world, primarily our investors. I and my team, we do sit with the investment team itself. We are actively engaged and involved in the discussions when it comes to investment strategies, so that we're on top of things, what they're doing. And our main responsibility is then to communicate our investment themes, our investment policies, the views to our investors. And actually, vice versa, also to gather their views and relay them back to the investment team itself.
That's got to be a tough job right now. We're sitting in a situation where we've had 3 years of declines in emerging markets, and clients are going to be wondering, well, should I stay in here?
Well, it's also, I think it's difficult in the sense that you need to find the right balance between not getting carried away by short-term rallies, such as, for example, the one that we've seen since mid-January, but also not perhaps not becoming too depressed basically by 3 very, very challenging years. It's very easy to just focus on the headlines and see the negative in emerging markets, and there's been a lot of negatives, and really finding that right balance, and also, and therefore actually making sure that our investors themselves continue to look at emerging markets from I would say it's from a certain actually distance perspective, is perhaps the main challenge.
I wonder how you split, though, the influence of the big picture, the Federal Reserve, which basically has dictated the way that emerging markets go for the last 2 or 3 years. How do you dissect that to actually get down to the local risks, the local factors in emerging markets?
Actually, we ourselves, the way we try to look at it is really drill down a lot from a top-down perspective. That's really step number 1. In essence, look at countries or look at issuers and try to identify whether there is a real causality between what the Fed is doing, or is it just purely correlation, perhaps to some extent even a spurious correlation. That's really step number 1. And that's actually, that requires, if you wish, a large team of analysts, which we luckily have. We have about 40 portfolio managers and analysts. So we do pretty much all our research in-house. And then we need to back that up with valuations, because it's very nice to talk about countries and economies not being correlated from, if you wish, or not having any causal link with the US. But if you can't invest, if you can't express that view through actual investments, it doesn't really help you a lot. And I think that's really what we're doing, or that's what the team is doing, and that's also where our input is coming from. Because what we add to the discussion is clients' views and concerns. Because clearly, the investor, the PM, and we have to be probably quite, if you were sort of agnostic about it, the PM itself is involved because he's running his own portfolio. So he's clearly not, he's not agnostic. He's got, if you wish, to a certain extent, an interest there. And what we bring to the action is the client's views, which are not necessarily similar or not necessarily the same as the investors, as the portfolio managers' views. And by this, we try to balance the discussion that is taking place within the team.
It's a really interesting point, that, because portfolio managers do have a vested interest in the funds that they're managing. They have to, and that's why we often talk about fund managers talking their books. They've got a set of portfolios that they're wanting to do well, and then there's the influence of the indexes as well. So the fund manager might be quite happy with themselves if they're not underperforming the index too badly, but if that index is dropping like a stone, the client isn't going to be too happy. But you're somebody who comes in the middle of all of that and takes it from the client perspective.
Absolutely, and I think you raise a very interesting and very important point there about the index. Because we also have, we have clients, particularly in pooled funds, in a regular CCAV or a fund, you have basically clients with very different motivations and very different investment objectives. Some of the clients are quite happy to basically just get the index plus a little bit up or a little bit down, because all they need or all they're looking for is an overall market beta within a global portfolio. But then there is another group of clients who, I think absolutely legitimately so, is looking for significant outperformance. And again, sort of finding the right balance is actually a major challenge for the portfolio manager. And again, to some extent, that's where the client portfolio, the client side is playing an important role, because we relay, or we try to actually, I wouldn't say not try to balance these interests, but trying to relay the right level of interest, basically what is really more important for clients. Because at the end of the day, I think investors need to make that call as well. Are they happy to keep just a certain exposure towards a certain market, or are they really looking much more for a proactive investment that gives you lots of upside and protects you on the way down?
So given the declines that we've seen in emerging markets during the past 2 to 3 years, have you seen fewer clients actually coming to your desk on emerging markets?
I mean, there were phases in 2015, to be honest, where it was a bit quiet. But it's been actually, I would say it's been actually almost a very sort of divided picture, a very split picture between what we would call retail clients, which is perhaps unfair. I would rather say sort of fund investors and investors who are looking for segregated mandates, i.e. tailor-made investment propositions. Now, fund investors, as we know from the numbers that have been published, they were pulling out of emerging market debt for a variety of reasons. Some of those investors are actually global bond investors, and as you rightly said, well, they looked at emerging markets and they felt that they were not really properly compensated for the risk they were taking. So they completely pulled out of emerging markets. Others felt that just basically volatility was getting too high and they scaled back. So a lot of investors who are not necessarily dedicated emerging market investors pulled out in 2015. But interestingly enough, we saw very strong inflow from long-term investors who are much more keen on locking in a yield, if you wish. Insurance companies or pension funds who have the ability to absorb volatility over an extended period of time. What they saw was actually a bond market that was offering very attractive entry opportunities.
So let's drill down to the actual economies that we're talking about. China, as well as the Fed, has been the major worry for global markets and emerging markets. How do you see China on a big picture level?
I think on the very broadest level, I'm almost tempted to describe sort of China as not as actually almost like a two-tier economy. You have obviously you have the modern media, so the digitalized economy, if you wish. And obvious names are Baidu or Alibaba. Those are the more obvious names, but clearly there are other parts of it as well. And then you have the much more traditional manufacturing, heavy industries part of China. And clearly the government's, one of the challenges of the government is, well, how do we strike that balance, basically? How do we make sure that we actually do get more money being invested in services, digital industries, high value added manufacturing, and getting away from low value added plus heavy industries? That's one part, but there are obviously lots of other moving parts in between there as well. I think one of the major difficulties, and that's to some extent a homemade challenge, is the fact that they still have a very closed financial system. So they've attracted a lot of capital, which helped build up their reserves, but at the same time also distorted domestically interest rates. So capital was too cheap. One of the reasons why China has overcapacity is because capital was, and to some extent is probably still, too cheap. So personally, actually, I'm much less concerned about capital outflow. To some extent, I think it's a necessary corrective that needs to take place in China. But I'm also aware of the fact that outside perception might be different.
So is the correction in China completed, or is there further pain to go?
I think we're still in the middle. There's been a bit more, to some extent, actually more encouraging signs by the leadership, because I think the Chinese leadership does realize the need to speed up these reforms. If you look at 2015, the impression was very much it was basically 2 steps forward, 1 step back. I think now it's time to say basically 2 steps forward and only half a step back, because they realize that they need to address leverage, they need to address the level of credit in some parts of the economy. What we're still looking for is confirmation that they're prepared to go the last mile or the last step, which is basically allowing bankruptcies, allowing defaults. That's something that we really haven't seen in the Chinese economy. And it's difficult to imagine how a leadership that is very much emphasized or very much focused on control can actually allow that to happen.
And do you think they will allow it?
I think eventually they will have to. I mean, and unless they basically even artificially prolong what is already an imbalanced situation, and therefore just increase the risk of a much more painful correction somewhere later down the road.
So it's similar in a way to what America and Europe have been doing. We also have been defending the biggest companies from collapse. China's doing the same thing.
It is very similar, yes, yeah, but to some extent, if you wish, there's sort of 2 things to it. One is kicking the can down the road, which is, if I may say so, been very much sort of the EU approach to reform. And the other one is, yes, providing additional finance, and that's what we see in China as well. So I fully agree, it's not very different. But I think the one element that is really different is the open balance of payments. I mean, both the US and the EU have an open balance of payments. So capital flows do make a difference there. That's what we're not seeing in China yet. I think that's why also concerns about capital outflow are so elevated, because there is that fear, almost it is probably even a fear, not just a concern, that if and when China fully liberalizes the capital account, we might just see a huge wave of capital leaving the country. It is probably exaggerated, or I think the honest answer would have to be we don't know at this stage, because we also don't know how capital account liberalization will be implemented.
So given your view on China, what do you advise clients holding?
Well, it's actually, we still like, there is a good range of industrial names in China, particularly export-oriented companies. So you're looking for companies that have dollar revenue, therefore they have, if you wish, a natural hedge on their balance sheet, in their P&L, against the dollar debt they have. Then we have to be quite realistic about it. In the Chinese context, we're also looking at companies that are of strategic importance to the leadership. That means basically the main banks. They will continue to enjoy government support because they are necessary to maintain the economy. Perhaps the most obvious sector where we have been reducing exposure in 2015 was real estate, because that is it's not speculative, but that is much more driven by local idiosyncrasies, and that's where it gets difficult also, because that's where transparency is much more difficult to achieve than in major companies that are operating in global markets. That's where we often, well, not often, but occasionally see suddenly, I would say, sort of local rivalries and local political influence suddenly affecting businesses. So that's why we need to be, those are the parts where we need to be much more careful. And clearly banks that are not necessarily perceived to be of strategic importance, second, third tier banks. That's also another element or another sector where investors need to be much more careful.
Okay, let's turn now to another huge economy for emerging markets, and that's Brazil, where the last 6 months basically has been chaos politically, economically. We've had the plunge in commodity prices, we've had the corruption scandal that looks like could be about to topple the administration of Dilma Rousseff. What's your outlook there?
On the political side, it's still very, I think we're still in a very, very difficult phase. I mean, politically, the country has been in paralysis now for, well over 6 months, perhaps even a year, if you wish. So certainly, I mean, there was no post-election honeymoon, and it's just gotten worse since then. And Rousseff being increasingly isolated does not necessarily help the situation, because if anything, she might become even more entrenched in her position, clearly more entrenched in her wish not to leave office. So now we actually need to see, is there really a sufficient majority in Parliament building up for impeachment? There's obviously, impeachment also hinges on legal technicalities, which doesn't necessarily help the case, because clearly Dilma supporters will feel that all the other parties are literally ganging up against her and coming up with slightly construed case in order to make, in order to get impeachment, in order to get her impeached. So that's not helping the political situation. And then looking forward, the question we have is still, well, is basically Brazil ex-Rousseff, assuming she leaves office for whatever reason, is Brazil ex-Rousseff going to be able to form some form of working coalition, functioning coalition, that then implements the necessary reform? And I do know there are views out there that are quite positive or quite constructive in the sense that, yes, once Rousseff's out of the picture, they'll form a coalition and basically they implement a lot of, or at least kickstart some of the reforms before the next elections. Personally, I'm still a bit skeptical, because the reason why Brazil politics is in such a dire straits is because it wasn't just Rousseff, it was pretty much everyone else was being part of that game. And now the question is, someone like Michel Temer or even Aécio Neves, do they really have the necessary credibility, the domestic credibility, to implement very, very painful reforms? That question still needs to be answered. So,
what do you mean implicated in that game? You mean that the corruption scandal went
far wider than the PT, far wider than just the PT and just Dilma Rousseff and her predecessor Lula. I think that would be far. That would be too. I mean, that would be very. If it was really just the PT and the leadership itself, I think then that would be a relatively. I'm not a small issue, but that would be easy to address. But pretty much all the parties have been implemented. Pretty much all the parties, at least who've been sort of close to leadership, basically used Petrobras as sort of basically as a means to get party financing, because that's what basically at the back of it. I mean, it's not even a particularly original way of corruption. It's been contract skimming at the heart of it. So that's why I think whoever is taking on post-Rousseff will have a very challenging job. Not because basically the amount of reform that needs to be implemented is it's very high, but also because there is that very high domestic credibility hurdle that needs to be met. But at least I think the best we can hope for is that when she leaves office, that this paralysis ends, and that at least will be some form of functioning coalition. But that's just part of it, because one of the main reasons why Brazil is in such deep recession is because clearly they need to address taxes, they need to address wages, particularly wages in the public sector, which are all index linked, which means basically they immediately add to inflation pressure in the system. They need to look at the way how BNDES and Caixa Econômica Federal, these are two banks that are government owned, have been also providing credit to the system, which has also added to the notion of excessive leverage, particularly in the state-owned part of Brazil's economy. They need to look at how Petrobras operations are being run. They need to liberalize domestic prices for basic services. So there's a lot of elements and that each of them on their own are very difficult to implement, and in their totality, that is going to be a major challenge.
So what do you advise clients in Brazil to do?
I think we're basing where we're flying basically by side to some extent. I mean, the market has priced in a lot of negative news. I mean, if you look at spreads in Brazil, I think at the peak they were wider than 1,000 basis points, which would imply, or which would be equivalent to a single B-rated country. We think that is too negative. Because if you look at the central banks, the central bank has maintained its independence. Central bank reserves are actually still at a reasonably high level. So Brazil is double B. I think that's what it is rated right now, and we think that's a fair assessment. So suddenly we're looking at a country where there is a lot of negative news. There are some elements that balance that to a certain extent, and then we look at the market that is probably far too negative. And that's where we start to look for attractive companies. But we're also quite open about the fact that this is, for want of a better word, this is a tactical position that we have right now. If there's more negative news coming in, we're prepared to very quickly reevaluate our position, our exposure towards Brazil. But we're also quite conscious of the fact that in the past, if you look at India started to rally about 6 months before Modi took power. Russia, although it's a bit of a special case, but nevertheless, Russia started to rally when it was downgraded. Obviously, Brazil is not there yet, but we're quite conscious of the fact that basically emerging market rallies always kick in before the news. It's a traditional adage, so basically buy the room, sell the news. And that's why we don't want to be too negative or too light on our exposure in Brazil in order not to miss the rally. But then obviously the follow-up question probably is what you buy. There are good names out there. I mean, if I may mention one without sort of pushing it, Vale, for example, world's biggest iron ore company. Very low cost base, benefiting from the fact that its costs are in real, whereas they're selling iron ore at dollars, yes. Currency has devalued, but that's only helped actually the P&L of the company. And they're clearly one of the companies that have the stamina to basically live through this period of low commodity prices for longer. If you look at some of the industrial sector, I mean, an obvious name is Embraer, the aircraft manufacturer. I mean, if you fly from pretty much any airport in Europe, you're likely, on short-haul flights, you're very likely to actually step into one of their planes. If you look at some of the industrial parts as well, or if you look at what they call protein producers, they're basically biggest beef producers as well. So I think the advantage of Brazil, I forgot the media sector as well, very strong. So Brazil offers a highly diversified economy, and that's again one of its pluses. Right now, it's been weighed down by a lot of negative external and domestic factors, but actually we find in Brazil a good range of companies that because they're based in Brazil, but they're not solely reliant on business in Brazil, offer very attractive return prospects.
Okay, one of the most complex countries, I imagine from your position, has got to be Russia, because not only have you got the uncertainty about the economy with collapse that we've seen in oil prices, but also the sanctions, and I'm not just talking about whether sanctions intensify or not, but you've got the potential risk that clients could face a day where they wake up one morning and they just can't invest in Russia anymore, that sanctions are ratcheted up. How do you deal with that risk?
That's a very good question, because it's because when sanctions kicked in, when sanctions were imposed, it was obviously I think we suddenly had to deal with questions such as, what happens if we get an Iran type scenario in Russia, which we felt was always exaggerated, because from a geopolitical perspective, I don't think that the US or the EU would like to completely shut the door on Russia. But nevertheless, we suddenly had to deal with excessively negative expectations about Russia. And now, since everyone's kind of have learned to live with the sanctions in Russia, we have to be careful not to become excessively optimistic, overly optimistic. I think for us, the way we navigate through it is we clearly focus on the secondary market, which is much more difficult because liquidity, particularly for corporate bonds, is not great. It's better for sovereign bonds, but nevertheless, we focus on the secondary market. We continue, obviously, to focus on non-sanctioned companies, which is the easy part. And everywhere else, again, it's to some extent it's similar to Brazil. It's a much more tactical position. It's not like, if I want to sort of draw a comparison, it's not like sort of Brazil's or Mexico sovereign, where you can comfortably say we buy and forget because we don't have to worry about these type of risks. So what we do in Russia is we do play it much more tactically, much more short term. That's another way of looking at it. Do I want to buy long-term interest rate risk? Do I want to buy long-dated bonds in Brazil? No, in Russia in this environment. Probably not. I'd rather stick to more shorter term, shorter dated bonds. Because in the worst case, let's assume a complete worst case scenario, US and the EU impose sort of overnight complete sanctions on Russia. And let's assume, just for the sake of argument, that Russia continues to be current on some of its obligations. Clearly, we do know that after a certain period of time, even Russia will not be able to maintain that. But if by having a bigger exposure to shorter dated bonds, at least you basically mitigate that risk instead of buying, say, a 20 or a 30-year bond, where you basically would sit on a lot of unpaid, or the likelihood or the risk of suddenly having lots of unpaid obligations. Okay,
so we've been through 3 of the BRICS. We can't leave out India. What do you make of the economy there? It's had a very positive run.
Well, India's been, I'm tempted to say, sort of everyone's darling for the last year and a half, and for the right reasons. They have a good range of diversified industrial companies. I mean, if you look at Reliance, if you look at Tata Industries, and sort of Vedanta, I'm tempted to say they're very much household names in any global bond portfolio. They're very efficiently run, profitable. They also offer exposure to the right sectors, and we still like that from a fundamental perspective. But we're becoming perhaps sort of less keen from a valuation viewpoint. It's still the right place to be. It's again sort of similar to or comparable to Mexico. It's kind of the credit you buy and you can sleep on it because you do know that the fundamental credit risks are very predictable and very low. But in an environment where suddenly risk appetite appears to have returned, do I still get the same type of sort of compensation for my risk, or perhaps is the opportunity cost of being still exposed to India not getting too high? And I think that's the kind of conversations that we're having right now.
Okay, so Zsolt, what would you say is your most contrarian call?
That's a good question. I'm not sure actually how contrarian we really are. I think we probably, we still quite, we hesitate to buy fully into the local currency rally that we've seen since mid-January. And to be honest, from a performance perspective, that was a tough call to make, because if I look at the local currency index, I think it's up 11% year to date. So clearly, one could say, obviously, with the benefit of hindsight, well, it was cheap, why didn't you buy? But it was cheap for a reason. And we still think the fundamental backdrop is not really solid enough to justify a sustained rally in local currency markets. We like interest rates in local currency bonds. We're still a bit cautious on the currency side itself. And in an environment where central banks are much less quick to intervene in their own currencies, the downside risk is still relatively high. Yes, currencies have sold off, but as we know, they can always sell off more.
Okay, so say I'm an investor, I come to you and I say, Zsolt, I'm quite happy being in developed countries, but I just want a little bit of exposure to emerging markets. what would you advise me to buy?
Just in one market. I wouldn't pick a country, but I would say buy investment grade rated sovereign dollar bonds, because you do get an attractive carry. It's somewhere in the region. I know it sounds very low for emerging markets, but it's somewhere in the region of 4 to 4.5%. But it comes with very low credit risk. Right now, you have exposure to what I would call almost like a clean up investment grade universe, because the critical crisis, particularly Brazil, has dropped out of that universe. And compared to what you would earn in Euro govies or even US Treasuries, you do get a very decent yield pickup.
Okay, now I'm another client. I love emerging markets. I've got everything there. What would you tell me, Gavin, avoid that?
Banks involved in consumer credit. Because that's where we've seen a lot of the credit expansion over the last few years. I mean, it's been this story of how should I say, basically the emerging consumer. But clearly that hasn't been always backed up by fundamentals, and I think there is sort of clearly a risk that some of these banks probably are overstretched.
Okay, so looking at the world, Zsolt, all of the emerging and frontier markets, which country is your favourite?
Favorite country? That's a tough one. Actually, if I look at sort of from a risk reward perspective, I will probably look at actually Russia.
Interesting. Tell me more.
As I said, it's oil prices are very low. So yes, the Russian economy is still very much commodity price exposed. There's no doubt about that. But commodity prices are probably at their lows. So if they pick up just a little bit, we will see the immediate impact that in the Russian economy. As I said, actually most Russian issuers are reasonably well run. We do know the ones that are perhaps less efficiently run. I mean, for example, Gazprom, but clearly also because Gazprom has other functions as well. But even within that context, companies such as Gazprom is reasonably well managed. I think, as I said, Russia still, it is still affected by the fact that there are sanctions in place. But I think the geopolitical environment is gradually moving towards a position where at some point sanctions will be lifted. There's clearly a debate whether it's going to be the US. The US has a lead on it. But if we look at the debates in the EU, I think there's increasingly less appetite for maintaining these sanctions. And it actually damages the EU economy as well. So for me, Russia is one where, particularly because it is exposed to commodity prices. So if we see just commodity prices, particularly oil and gas prices, just picking up a little bit more than what we've seen, we will probably very quickly see an impact on that in Russia.
Okay, so in Russia, what do you buy? Which bonds do you favour? Which companies do you favour?
I would, yes. We would. I just forgot the name of it's Lukoil. It's probably I would suggest Lukoil. It's privately owned, but they're very well managed oil company, and they're not. I think basically both Gazprom and Rosneft, which would be from a size perspective the obvious choices, they need to invest a lot in their infrastructure. Obviously Gazprom, Gazprom in order to maintain the trunk pipeline, which is quite costly, and Rosneft in order to develop new oil fields, because the yields on the existing oil fields are gradually decreasing. Lukoil, on the other hand, to the best of my knowledge, they're basically, their investments are still higher yielding, therefore much less affected by, to some extent, by non-governmental functions. I mean, we do know Gazprom in some places is basically the only Russian entity that is present, so it has other functions as well, and that's not the case for Lukoil. I'd say so within the oil and gas sector in Russia, I would say my choice would be Lukoil.
Okay, Zsolt, and which country do you have the most concern about? Where would you say avoid?
Okay, which one? Well, I would say it's the one where I still have biggest concerns about personally, and actually I have to say Russia, that was also my personal call, Ukraine. Which again is probably not a big surprise. Still involved in a war with its neighbor. It's not even, and I'm not not making any judgment here about who's to blame or not. I think that's irrelevant. The fact is the Ukrainian economy has lost something between 20 or 30%. That it's unlikely to be rebuilt. That's very difficult to replace. They just about got an IMF deal last year. The IMF basically bending its own rules. I think we have to be quite clear about that. And I think there is a growing sense of a sort of dissatisfaction growing, particularly within the EU, about the lack of reforms by Mr. Poroshenko and his administration. So whilst I think that's for geopolitical reasons, I think the EU and the US are prepared to provide more financing. It's not something that can go on perpetually, particularly if for whatever reasons relations between the EU-US on one hand and Mr. Putin improve, then suddenly Ukraine could find itself in a very, very difficult spot.
Thanks so much, Zsolt. A very interesting conversation. I'm Gavin Serkin for Frontera TV, and I've been speaking with Zsolt Papp, the Global Head of Emerging Market Debt Client Portfolio Strategies at JP Morgan here in London.